Hi, welcome back to Father and Son Investing. The Consumer Price Index numbers came out this morning, the CPI, and those numbers were running hot, as I kind of talked about in the first short video that I did yesterday. Today we're going to talk about just what the CPI had to say. Then we're going to talk about what the effect was on the Treasury market today. We're going to talk about some recent developments, particularly in the 3-year and the 10-year Treasury auctions, some news that you may not have heard. And then I'm going to give you my outlook on where I think Treasury yields will be going in the next little bit. Bottom line up front, I think the 2-year, 3-year, and potentially the 5-year Treasury notes are going to have some room to run here in the near future, and I expect to see those yields going up. So let's get started. Before we actually get into today's video topic, I want to thank all of you for watching this channel. In fact, we are coming up on a momentous occasion for us. We're going to have our first video hit 50,000 views soon. We're about 50 views short. So if you want to help us out, please go and watch this video. Treasury bills, the disadvantages, know before you buy. Now, just know that I'm not saying negative things about Treasury bills here. I've had a lot of comments thinking that I am dissing Treasury bills. I am not, but I think everybody should know what the disadvantages are of a purchase they're about to make. So if you want, watch that one and drive us over 50,000. All right, let's get a quick look at the CPI numbers that came out this morning. So what do the numbers look like today? Here's the graph of what's going on. This purple line here is one we're going to want to keep an eye on. This is the headline CPI. This is the total consumer price index. And what you'll see here is that there are 2 consecutive months now where headline CPI has gone up. It was 3.7% year over year. That's up from 3.2% year over year that was reported for July. Let's also take a look here at the core CPI. It came in at 4.3% year over year. Of course, core CPI is what you get when you strip out gas and food prices. The other big thing to know, though, about the core CPI is that it went up 0.3% month over month, and that is compared to 0.2% for the July numbers. So again, an increase in both the month over month core CPI and the headline CPI, and an increase in the year over year headline CPI. And then 2 graphics here just to reinforce what's going on with inflation, because of course this is really probably the biggest factor that's going to affect your yields on your U.S. Treasury bill note and bond purchases. So you'll see that gasoline 10.6% up month over month for August. Of course, that was driving a lot of the inflation for the month of August. You'll see there are a few things here that have actually gone down. Used cars and trucks, that's a nice thing to see some of those becoming a little less expensive. Let's look at some of the year-over-year numbers, and this really drives things home. You can see here 2022, of course, that was horrendous, where we were seeing these huge 8+% year-over-year. But notice that for June, 3.1%, then a little uptick, 3.3% in July, and 3.7% for August. I think the Fed is going to be paying close attention then to the numbers for September that will come out in October. That'll be actually the last numbers that they're going to get for CPI before they have their meeting in November. If this comes in again running high, I think there's a high likelihood that the November meeting is going to be accompanied by an increase in the Fed funds rate. Let's use the Barron's website to see how the bond market has reacted to these CPI numbers today. You'll see here that from the 2-year to the 30-year, the bond prices have gone up, meaning the yields have actually gone down just a little bit. That's a little bit surprising to me, given that I think that inflation came in running kind of hot here. But if we look at the Treasury bill market, you'll see that except for the 1-month Treasury bill, the yields have gone up just a little bit, meaning that the price has come down just a little bit. So that's how the market reacted today. I expect to see a reversal here of some of this downtrend. Why do I expect that? Well, here's another graph that says exactly what happened with the 3-year Treasury note auction that happened earlier this week. It had the highest auction yield since 2007. Here we are way back in 2007, and look at how high it has gone. Look at how much it has increased just over the last couple of years. So just what was that yield? There was $44 billion worth auctioned, and it came in at 4.66%. So that's some interesting data going on with the 3-year Treasury note. How about the 10-year Treasury note? What's going on with the 10-year Treasury? Well, the headline here says it. 10-year Treasury bond auction sees weak foreign demand and highest yields since 2007, much like the 3-year Treasury note. What did the 10-year Treasury come in at? It was $35 billion in reopened 10-year notes. They essentially reopened the August auction, and they came in at a yield of 4.289%. That is the highest in any 10-year auction since 2007. So that is two very interesting data points here for what's happening in some of these more longer term notes. Previously, all the action was kind of going on in Treasury bills, but we're starting to see now some increased action in terms of yield on some of the longer term notes here. All right, let's get to my bottom line of what I think is going to be happening then over the next few weeks for Treasury bills, notes, and bonds. I think that Treasury bills don't really have a lot of room to run. You know, the federal funds rate high is set at 5.5%, and so all of these are kind of topping out here near that. But where we do have some room to run here is starting at the 1-year Treasury bill. Currently, we're looking at 5.42% yield. That's getting close to that upper 5.5%. So there's a little bit of room to run, but not too much. But if we get to the 2-year, 3-year, 5-year Treasury notes, I think that this is where the action is going to be occurring. We saw the 3-year Treasury note highest yield since 2007. I think we're going to start to see some of that action here in that 2 to 5 year Treasury note range. Of course, I picked up my first Treasury note. I was waiting for 5% at this last auction, and it came in right at 5%. It's still hovering right around that 5% currently. But the 3-year Treasury note and the 5-year Treasury note auctions are where I'm really going to be interested in. I don't really want to touch the 3-year until it gets closer to that 5% yield, so I'm going to be keeping a close eye on that. Just when are these next auctions going to occur? We're going to turn to the tentative auction schedule that you can find on the Treasury Direct website. We'll see that the 2-year note will next be auctioned on Tuesday, September 26th. The announcement will come out on Thursday, September 21st. And the 5-year note will be auctioned the following day on Wednesday, September 27th. If you're interested in it, the 7-year note is the day after that on the 28th. All three of those then will be auctioned after the Fed actually meets on September 19th and 20th. By the way, one other bit of news that can affect how your Treasury bill, note, and bond yields go this week is going to be the PPI that comes out tomorrow, the Producer Price Index. That is the price that all of these businesses who are making the goods that we sell are paying. So we're going to watch to see whether PPI also went up similar to CPI. That's all I've got for you today. Until next time, enjoy your investing.